Hello, everyone. I hope your day is going well. So we're off to the next session, and the $5.1 trillion a day FX market presents brokers and other participants with a gamut of challenges. In this talk, our panel of executives from various areas of the industry gather to discuss the touch points of retail brokers and institutional LPs, such as liquidity, the impact of MiFID II, and many more. So, Hormoz, take it from here.
Yep, thank you very much. Thank you for joining today's panel about FX liquidity. My name is Hormoz Faryar. I work for Equiti Capital here in London, which is part of the larger Equiti group, which is a very fast-growing FX brokerage, CFD brokerage, very traditional with a big capital behind it. So today we have a great panel. I happen to know everyone here since a few years. Each one of them is a great entrepreneur. You can tell by none of them wearing a tie. So let's start with a quick introduction. If you guys could introduce yourselves, starting with you, Marc.
Hello everyone, I'm Marc Levin. I'm the Chief Commercial Officer of CFH Clearing, which is part of the TradeTech group. So for those of you that don't know TradeTech group, it is the financial arm of Playtech, which is the biggest gaming provider in the world. So looking forward to this and speaking to our friends up here.
Okay.
Good afternoon, my name is Hopkins. I'm the founder of FairXchange. We're a data science firm providing execution analytics to participants in the FX market, focusing on algo execution and liquidity management. Before I set up FairXchange, I ran the e-sales business at Morgan Stanley for about 8 years, so have a little bit of insight as to kind of liquidity provision from a bank perspective as well.
Hi, my name is Juan Colon. I'm a co-founder with Darwinex, part of the Darwinex group. Just kidding. And
We'll get a group one day.
Well, we'll get there. We'll get there. We are a retail broker, so we are the other side of these guys' fence, and with a bit of a different touch, because what makes it slightly different is we have a DMA only model. We don't B-book, and also we have an asset management franchise which is growing and basically funneling larger and larger tickets onto these guys, and we're now kind of learning the ins and outs of what happens when you start trading with 10 million instead of 100K. And part of that lesson, hopefully, we'll share today.
Okay, great. So before we start, I wanted to briefly let you guys describe how you see the market as it is now. So in this space where we are, we're focusing today on FX. No, I don't want to hear cryptos. So what's your view of what the market looks like? So we have end clients, we have brokers, we have prime of prime brokers, then we have prime broker banks, and then we have the liquidity providing banks. How do you see, each one of you, how that market looks like right now? That was a very simple description, but how do you see, from your perspective, how the market looks like? So Guy, if I start with you.
Yeah, sure. I mean, from my experience of working in this space, I mean, having been at a bank, you know, the bank's got many different types of clients that trade foreign exchange, from macro hedge funds, systematic CTAs, pension funds. This part of the market is easily the most complicated. There are so many participants, there are so many flows, all different sorts of institutions interacting with one another. So the information flow is very, very, very complex and very diverse. And that makes liquidity provision a challenge. Obviously, if you are pushing liquidity out the door, you don't really know where it's going to end up. So I think increasingly, institutions that are involved in this space, particularly on the liquidity provision side of things, have tried to take a much more collaborative approach to working with their partners on that distribution of liquidity and make sure that liquidity is going out the door is being used in the right way. And I think that increase in kind of collaboration around liquidity is a very, very important one.
Marc, how about your view in terms of, you guys are a more traditional broker taking retail or institutional kind of retail brokers. How do you see that space?
Yeah, so I mean, we've been sourcing and aggregating liquidity for 10 years. We're really the first STP liquidity provider back in 2009. Back then, it was even more fragmented. There was very little technology to actually make liquidity provision possible. So we went away and built our own systems, our own aggregation system, our own reconciliation system, how to manage a fragmented liquidity landscape in the background. But one thing is what is definitely happening in the space is the consolidation that's happening, and that's all the way from the prime brokers pulling away from this space altogether. That has an impact on the prime of primes, but also on the retail side with the increase in regulation. It's definitely getting more consolidated, and that's of course one of the things that we see, and one thing that we want to strive on is really to be a leader in that regulated environment. The same thing happened on the gaming side for Playtech over the last 20 years, so there's nothing new there. But I think consolidation is definitely what's happening across the board.
Juan, and you guys are slightly different, so your view of the general marketplace, how's that?
I mean, I guess one challenge, which is why the regulators are probably stepping in, is to explain to customers that different customers can have different prices for one and the same asset at one point in time, and maybe that's one of the reasons why the regulators are all over the place. So maybe there's something fundamental that might need to change going forward. I don't know.
Yeah, I guess it's very difficult generally in FX to guarantee that everyone gets the same price at the same time globally, etc. Very difficult subject. I wanted to talk about non-bank liquidity providers. So traditionally, banks have been providing liquidity. They've been pricing, and then so we as Equiti Group, we take liquidity from the banks and we provide it up to the rest of the chain. But there is, of course, now a lot of non-bank liquidity providers. Now, that's a difficult subject for us and for some of the market, because a lot of these old high-frequency trading firms are now rebranding as non-bank liquidity providers. And it's difficult to know whether it's genuine liquidity or they just want to say that we take risk and they provide liquidity. They want to be where the banks are. Are they good? Are they not as good? What do you guys see out there? Guy, what's your experience with your analytics?
I think there's no question that the non-bank LPs have added a lot to the lots constructive to the FX market. Clearly, they are a force to be reckoned with. There's some very big players, and they're extremely talented at what they do. I think one thing they have obviously been very keen to acquire is a kind of patina of respectability, for exactly the point you just said. That, invariably, clients trading foreign exchange want to know that their liquidity providers are going to be there for them when things are going seriously wrong. And that's something that non-bank liquidity providers have always really been at pains to point out. So you see that in, a lot of them are undertaking exercises to kind of really demonstrate thought leadership in the market. They've got, seats on a lot of the committees of, the Bank of England type stuff, which is all really, really important, very, very helpful. I think it's also been quite good for keeping just the broader panel of LPs on their toes and cause them to innovate, which I think is only a good thing. And the conversations I've had with customers that use non-bank liquidity is that overall the experience is a very positive one. I mean, fundamentally, liquidity has changed over the last few years. It's got a lot thinner. There's lots and lots of much higher refresh rates of tick updates. Small liquidity bands being priced. In general, liquidity isn't as deep as it used to be, and that's equally true of banks as well as non-banks. So I think they have a big part to play.
Well, I think the biggest problem with non-bank market makers has been for us the reliability. So when we put out liquidity to our partners and clients, we guarantee them a two-way price for 25 hours or 24 hours, 5 times a day, 5 times a week. And with non-bank market makers, that has not always been the case historically. They go in, they make a price when they want to, and then they pull out again when they don't want to be in the pool. And that's simply something from our point of view that you cannot rely on. But that has evolved over the years, and it has become better. But at the end of the day, there's only a handful of true market makers, the major banks that have inventory to actually create a market, a two-way market for all of the hours that we need to price our clients. Yeah.
Okay, and Juan, do you have anything to add on that side, because you're dealing with many non-banks, I guess?
Well, I mean, we've seen an increasing share from the flow we get. So I guess they're bringing something to the table. Otherwise, they wouldn't.
But
be
you
there.
believe us when we say which are good and
of course.
non-banks.
Always.
Yeah, so I wanted to move on to the analytics part of. So with analytics, you can see a lot of what's happening. So there's a lot of data coming in now. There's a lot of analytics needed, both in terms of customer behavior and how prices are made. So price formation. How has analytical tools impacted price formation and pricing engines, essentially? So Guy, in terms of probably you saw a lot of that at Morgan Stanley, and you're analyzing that now, so you're on both sides in that sense.
Yeah, so I think one of the biggest challenges faced by firms within this kind of space is that, as I alluded to earlier, they've probably got some of the most complex businesses out there, and yet they're not necessarily armed with the kind of information and tools and data they need or understanding to have a kind of meaningful conversation with their LPs and perhaps their clients as well around the flow that's been going through their books. So to a degree, they're reliant on the information coming from the different banks saying, well, we like this, we don't like that. You know, that becomes very difficult very quickly to normalize because some banks are very open, some aren't. Are they really giving you the full stick? If they've just dropped $50,000, are they going to be honest with you about that? You know, where they'll probably say, oh, we're smalls down, we're making some changes, you know, the usual stuff that you kind of hear. So access to data and access to analytics helps level that playing field. So, you know, and that's not in any way to try and, you know, catch the banks out or anything like that. Indeed, it's quite the opposite. In many ways, the banks, I think, want to their clients to have access to information that they have access to so they can have a meaningful, informed dialogue around performance.
Well, I hear two things about that. So I hear some banks genuinely don't want transparency. That's what people feel. But so you're saying some banks are saying, look, we want transparency, we want to give all the tools to clients, we want everyone to know what's going on here. Is that genuinely?
I think the more forward-thinking guys know that that's the way the wind is blowing, and they are pushing the envelope. You know, some of the non-bank guys are doing that as well. And I think, I mean, to be blunt, if you're relying for a sustainable business in the long term, or relying on opacity of information, given how much information there is out there, that's not going to be sustainable in the long term. Clients are getting much, much more clued up. I think that's right, because not just because I think they need to be able to have that dialogue with their LPs, they also need to be having the dialogue with their clients. Because ultimately, they are providing that liquidity to their customers from the LPs, and it's incumbent upon both them and the clients to use that liquidity appropriately. And the data helps you do that, and you can have a conversation with your clients around why is their flow difficult, why do the banks struggle with it, and overall work with their clients to improve the profile of the flow, and then ultimately, then hopefully a virtuous circle, the banks make more money, and then everyone wins.
Yeah, I think, so at Equity Group, we try and, so of course there's the regulation part of things where you have to analyze things, and then we try and go beyond that and give the clients quite a lot of analytics when they need it, if they're big enough. So I've seen a lot of changes in that field. How do you see the impact of analytics on your business, Marc? So the last few years, do you provide a lot of stuff? Is it bad, good?
No, absolutely. It means that data has, for us, our order flow has been a sort of a black box. We had tons of data. We had tons of different price feeds, aggregations, order flows. But we didn't actually know how to analyze it. We didn't have fancy charts and tools how to analyze this. And Guy and I actually had a conversation this time last year where we said, okay, how do we create these tools? How can we actually access some of the information that is in the order flow that we do receive from customers? And I think that there's two sides to this when you do liquidity provision like CFH do. There's the bank side, where we need to be on our toes, ensuring that the banks behave as we expect them to behave. And there's also the client side. So when we have a conversation with Juan about liquidity, we can actually say, okay, this is how the flow looks. This is how the banks, they measure it based on P&L. This is the cost of rejects you do experience on some of your flow. These are the banks that are not behaving. And then we can actually have a much more meaningful conversation based on data instead of just a gut feeling or a hint from a bank. We can actually go in and validate and evidence everything that is happening in the system and with the order flow and the pricing. And that just makes the conversation with the clients as well as the LP a lot more constructive and meaningful.
So Juan, of course for you guys there's a lot of analytics involved generally, because it's basically a lot of what you do is relates to analytics and performance.
Yeah, much of what we've done is really educating customers about what it means to trade well, and part of it is the execution. And believe me, one place you don't want to be is our customer service team when there's been a price spike at night. You really don't want to be there. Because it's a very difficult discussion to have. Was the price here? Was the price there? And there's 55 places where they say it was, where it wasn't, and it's just it ends up in potentially in a broken relationship, and it costs us a pretty penny because typically we pay out of to make good on the customer relationship. And if there was one price which settled the score, that would be a good place to be in. A better place, and actually I think as a collective group, if we don't get there, FX will miss a chance as a potential asset class for investment, really.
Guys, so in terms of data, there's so much data being generated in FX. There's huge amount of data. It must be extremely difficult to synchronize the data, knowing the timestamps, the microseconds. Is there too much data, or you like more data, or how do you guys look at data? Is there...
There's a couple of angles to that. Firstly, FX is actually, whilst it's incredibly high volume and the number of data points going through is very, very high, it's actually quite a simple market compared to other asset classes. All the instruments are broadly the same. They've got different codes. It's not like you've got hundreds of thousands of credit issues or anything like that. So it's a reasonably defined universe. So it's quite easy to kind of get your head around like that. Also, depending on what you want to do, the data requirements are more or less punitive. If you want to build a statistical arbitrage model that's going to arb the different ECNs, then yes, you're going down to microsecond, and below kind of data levels. If you're wanting to measure market impact of a client, then you need a period of time over which it's going to happen. So you're talking about multiple seconds or even multiple minutes. So yes, you still have a lot of data to process, but it's not quite as granular as it might be if you're running a trading model. But this is the kind of analysis that does lend itself to very large data sets. You can only really infer conclusions over a very broad series of observations, because obviously you need to average out kind of the effect of idiosyncratic liquidity on particular days, that sort of thing. But over time, these patterns do make themselves quite clear. Everyone says FX is a random walk process and it's impossible to predict, and many people have tried and failed to predict where FX is going to be, and that's true. But when you see kind of mark-out curves, for instance, they are actually very consistent, and they have a very, very defined pattern, and there's lots of information contained within it that's very useful for making tangible impact on your business.
And I guess the cost of data as well. So how do you guys look at the increase in terms of data? Too much data? Is it a hassle for you guys? How do you look at it?
I think the short answer is that, at least according to some of the IT guys and the guys that actually look at this data every day, is that you cannot get enough data. They're like the data junkies, I guess. And every time we say, hang on, we need to pay X amount of thousands of dollars to store this. Yeah, we're going to need it maybe sometime in the future. Like, okay. So I think the short answer is no. The data is very valuable if you know how to analyze it and how to normalize it and how to put it into a system that makes sense. But it is getting very costly to of course, store all of this data, which is worthless unless you also have the infrastructure in place to being able to actually action it and analyze it properly.
I wanted to get into something a bit more technical. So a couple of the technical things. Speed bumps in terms of bank liquidity. Guy, what's the definition of that, and what is speed bumps?
So,
very simplified.
When you're looking to trade FX, the cost of transferring that risk has a price. Okay. When you are provided with electronic liquidity, and there's a lovely, what looks like a deep book, which is provided by a load of different liquidity providers, and you've got razor-tight spreads at the top, the temptation, rather than to trade a full spread if in 10 million, 100 million, whatever it is to hit the top of book 100 times. Now, if you do that, you effectively trade 100 million at the price in 1 million or below, which obviously structurally underprices the risk that you've transferred. And it usually means that the person or people on the other end of it lose money. So speed bumps essentially mean that when you trade with someone, they will back off the side of the market you've traded upon. Now, that can be good in some ways and can be negative in other ways because, of course, if you back away as someone who's taken on some risk, someone's there stepping in where you were, they're getting some risk, and then they do the same, and then someone else steps in, and suddenly that risk is dispersed across a whole bunch of liquidity providers in the market, and guess what? They all try to hedge at the same time. There's a rush for the exits, and everyone loses money. So speed bumps in and of themselves basically a way of LPs backing away from providing a constant spread. But they're not always the panacea that people make them out to be, to the degree that these days many banks are saying, we will provide you a full amount stream, which we will give you a discounted price on what we're currently showing you, as long as you can assure us that we get the entirety of your trade and it's not going to go anywhere else. So they're mostly protective measures, speed bumps, to stop people machine gunning liquidity.
And, I think just to add to that, on the, speed bump, I know you're talking about the bank liquidity, but on an exchange is actually a good thing because it levels the playing field of the participants on the exchange, right? Whereas in FX, it's become a sort of it has a negative connotation to it, speed bump, hold time. But if you have a no last look liquidity, this is a sore point for Juan, so I'm sure he's going to say something afterwards. But if you look at the no last look, the banks can price no last look or no hold time. It simply means that they're just going to protect themselves and be slightly wide on that price because they don't have that defense mechanism in there.
Juan, did you want to add anything on that one?
Well, it goes back to the challenge of what is the true liquidity? Is it where is the market price, right? There's no transparency there. It's part of the structure of the market. As long as it's set up like that, you have to.
You're a big fan of taking all FX into a one exchange and one guy controlling everything, right?
Well, I guess I could take a lot of lessons from these guys, but the fact is, from the retail standpoint right now, the retail guys can only be liquidity takers today. They cannot be makers. So, and that de facto means an asymmetry where there's the house, which can lay bets and take bets, and there's the players who can only take bets. And I think as long as that remains like that, we're going to be, everybody in the industry is here, but imagine having the FCA at a panel here, right? Like that would be unthinkable.
Oh, we would never invite
We
them.
would never be, that's always going to be the big elephant in the room, I think.
Yeah. You mentioned last look. Last look is quite interesting. It's quite controversial. So my definition of that is that someone wants to buy something and you give them a price. They say, yes, I want to buy at this price. And then you look around in the market and then you say, actually, no, not anymore. I'm not interested any longer. Seems very unfair. Only the LP can do that. And they decide which clients they want to do that to or where and which. So that seems pretty scary, and I don't know what the FCA is going to do about that, but it looks pretty funny, the whole last look thing.
So, obviously, last look has been a very controversial subject for a number of years, and the committee had put together the Global Code, looked at it in depth, the FCA's looked at it in depth, the Investment Association looked at it in depth, and I think there is broad agreement that last look in and of itself is a commercial practice which it wouldn't be appropriate to ban it outright. But the thing you have to remember is that it's a very broad subject. So initially, where last look came from was banks found that every time they traded with a client, they lost money every single time. And banks aren't always. There's a few people who've been in court recently, and there's been fines paid. But I think to characterise the banks as the bad guys and the liquidity takers as permanently good guys is probably inaccurate. And banks did find that, hey, every time we trade this guy, we lose money. So why don't we wait a little and see if every time that we do trade, we're going to continue to lose money, and guess what we do? So we're going to start rejecting their trades. So last look really started out as a P&L protection measure for banks. Now, I'd argue that they're probably doing what they should be doing in terms of trying to protect the banks' finances by doing that. Where it gets a little bit more problematic is when there's accusations of the bank is using the intention to trade information as a way to then initiate their own trades. So there's this whole thing around the pre-hedging in the last look window. So when the client goes to trade, the bank says, actually, you know what, I'm not going to trade, but they then trade before rejecting the client because they know the client's going to have to come back and put that trade on with somebody else, and they're taking a position. That is obviously a very, very different picture. So I think we need to be quite careful about what we actually define last look to be and what it's being used for. As a P&L protection measure, I think it's probably okay. And I think the IA, the Investment Association, said the same thing. As long as there's transparency and disclosure about how it's being used. Why is the bank using last look? Will they tell the clients why they've been rejected? If you look at, still today, if you look at the reasons that come back on the fixed messages why you're rejected, they're ridiculous. Sometimes there's no message at all. Sometimes like price not there, some internal failure. It could be a credit issue. It could be obviously the price has moved. The bank should just tell their clients, this is why we are rejecting your trade. And I think that will go a long way to deal with some of the controversy around this practice.
To regulate the details of last look.
Just be a bit more structured. I think this is the perfect thing to have in the global code. You know, this is this thing that people sign up to, and you know, pretty much all the banks are signed up to it now. And you know, it's a voluntary thing, but you know, it's just a way of normalising and standardising behaviour. I think this is a perfect candidate for that.
Juan, do you guys last look? Do you see it as a rejection? Do your clients look at it? Do some of them understand it? Or
I mean, the basic, again, comes back to the stigma, right? If you ask the standard retail trader, they'll just say brokers are all crooks. So it's
because they rejected my trade.
Yeah, they rejected my trade. Of course, there's a lot of kind of negative selection. You could slip the guy 25 times positively, and the one time where he's got hit negatively, you're a crook. There's a bit of that. But ultimately, the lack of transparency, it's paid at the end of the chain, right? It's like it's the end customer that complains, and the voice doesn't always get heard, I guess.
Yeah. So, Marc, do you guys last look? FCA is not in the room. You can tell us everything, Marc.
So, we don't act as an execution venue. So we act as a prime broker, as a prime of prime, where we have liquidity providers in the back that we aggregate. So we just receive the order and transfer it to an executing LP that had the best price at the time. So as such, there's no, from a CFH point of view, any last look or any execution of the order. We go out, we get a fill from the LP, and we take that fill back to the client one for one. And that's always been the model of CFH. But of course, some of the LPs we can see have higher hold times than the other ones. We can also see who's extremely good and behaving nicely. So it is a mix on our side, on the banks, how they price and how the engine works. It's really a conversation that we have with the liquidity takers in terms of how do you want your liquidity pool to be constructed, who do you want in there, who do you don't want to have in there. And that's why I think this whole thing about FX, you have a different price for different clients, is an element in FX that's unbelievable to believe if you come from an exchange world. But as is effectively why, because there's different parameters to look at when you do provide liquidity and you do execute orders in an FX world.
It's just there's one thing to bear in mind as well, which is the average bank providing liquidity to customers will let in an enormous number of trades that are loss-making. They will have this whole thing about they'll have a threshold at which they decide to reject the trade, some dollar number or something like that, which will mean that they will still take in lots of trades that they lose money on because they value their relationships. And if they just switch that all to kind of zero, they'll reject an enormous number of trades, simply because it takes time for the price that the client's trading on to get to the bank for them to then actually feel the market's probably moved. So there's a lot of, banks do go quite a long way to try and accommodate that. But it does mean that ultimately clients can get rejected.
But I feel like maybe it's because it takes them a while to analyze that data. If analytics is faster, maybe they turn things off quicker. Is that an element as well?
Yeah, I think there needs to be a balance. And when you get into the world where banks are saying, well, that tag's bad, that switch them all off. We only want the good flow. I think you quite legitimately, if you are someone that consumes bank liquidity, say, well, actually, this is a portfolio. Not all of our clients are always going to have 100% profitable trades to you. So there does need to be a slightly more kind of holistic approach to it. And I think that's just where the relationships that the likes of CFH have with their providers and Darwinex are so important, because they can have that discussion about the kind of the overall business rather than the kind of just getting down just to cherry picking.
Okay, so Juan, I wanted to ask you a little bit about types of clients. and the importance of that. So at Equiti Group, for example, we have a lot of different types of clients. And the reason is we have so many different offices quite evenly distributed across the globe. So we don't have one type of client. We're not focused on, let's say, hedge funds or anything like that. We're quite evenly distributed. So that's for us at Equiti Group. Some brokers might have it differently. They might have it that they are specialized in certain type of flow. In your view, is it a benefit to be specialized, or is it better to have a variety of types of clients? You probably feel, I don't know, you guys feel you have one type of clients or different type of asset managers?
Actually, we don't have one type of client, and I think and that has been one of our mistakes in some ways, because if you cater at the same time to guys who are kind of burn and churn $500 because they hit on Darwinex and hey, they've got good spreads, just do it with them. And then at the other end, you've got really sophisticated retail or kind of professional traders. Then if you don't choose a certain type of customers, then you basically need a PhD in Wharton to discuss at a proper level with the asset manager, and you're not going to put that guy to discuss with the burn and churn guy. So I think there's benefits in focus, and that we have really learned in a painful way.
Okay. So what do you think, Guy? It's a benefit? How did you look at it when you were at Morgan Stanley?
Well, any bank will tell you, any market maker will tell you need a diverse book of business in order to be able to internalize as much as possible. If
they still want the best clients.
Of course, good clients. I mean, everyone wants the good clients, the unicorns. But ultimately, if you've got guys giving you risk, you need guys to take you out of it. And those happen to be, invariably what tends to happen at banks is they usually have they would term a kind of a soft franchise. If it's a corporate bank, it's going to be their corporate clients. If it's an investment bank, it's probably prime brokerage clients. I mean, equity prime brokerage rather than for FX. So those are the guys who probably have the softest flow for that institution. But when they got risk, they need to get rid of it. And you can't rely on those guys that come in and trade once every 2 weeks to take you out of a €50 position. They're just not going to be there. So you need to be showing liquidity to the much, much faster turnover clients, which is the systematic funds, the retail broker dealers, all those guys. And other banks to get rid of that risk. So you do need that diversity of clients in order to be able to retain some spread in the middle.
Marc?
Yeah, I totally agree. It makes it a lot easier for the executing LPs to then look at the flow from a portfolio point of view. So, okay, there's a bit of bad stuff coming in here, but overall, it's a good relationship. We're going to accommodate the more challenging flow as well. And that is the result of a diversified flow of orders.
Great. I think, guys, this is a very short panel, so we don't have time for any more questions. I don't know, if, Michael, do we have time for a question from people? I think everyone has a question in here, so we have room for one question about FCA or cryptos. Any questions? We covered it all, I think, Michael. Thank you, guys.
Thank you, guys.
Thank you.
Thank you.